All right, welcome back to Financial Market Insights for Traders. I'm Sophia, and today we are diving into something that affects every single investor, whether you're just starting out or you've been in the markets for years. We're talking about why investors panic at the worst possible time, and more importantly, what's really going on beneath the surface when that happens. Because here's the truth: market cycles are nothing new. We all know, at least intellectually, that markets go up and down. Bull markets, bear markets, corrections, recoveries. It's part of the system. And yet, when a real downturn hits, that knowledge often disappears. People who felt confident just months earlier suddenly start questioning everything. They hesitate, they second guess, and very often, they panic. This is where investor behavior bear markets becomes incredibly important. Not just as a concept, but as something you can actually observe in real time. Let's start with the emotional side, because that's really where all of this begins. Investing isn't just numbers on a screen. It's deeply tied to how we feel about security, progress, and the future. So when markets fall, it doesn't feel abstract. It feels personal. And one of the strongest forces at play here is something called loss aversion. In simple terms, losses hurt more than gains feel good. Losing £1,000 feels far more intense than gaining £1,000 feels satisfying. So when your portfolio starts dropping, even if you understand that markets are cyclical, your brain shifts into protection mode. It starts telling you, do something, reduce the damage, get out before it gets worse. And that instinct is completely human. It's not a flaw. It's how we are wired. The problem is that in investing, acting on that instinct at the wrong time can lock in the very losses you're trying to avoid. Now, let's talk about how fear actually changes the way we think. When markets are stable or rising, it's easy to think long term. You're focused on growth, on compounding, on where you'll be in 5 or 10 years. But when markets start falling sharply, your time horizon shrinks almost instantly. You stop thinking about years. You start thinking about days, even hours. You start asking questions like, what if this keeps falling? What if this is just the beginning? Should I sell now before it gets worse? And those questions feel rational in the moment. They feel responsible, even. But what's really happening is that fear is narrowing your perspective. It's making temporary volatility feel like a permanent trend. This is one of the defining patterns of investor behavior in bear markets: the inability to zoom out when it matters most. There's also another layer to this, and that's the illusion of control. When markets are going up, doing nothing feels fine. In fact, it feels smart. Your portfolio is growing, and there's no pressure to act. But when markets fall, doing nothing suddenly feels uncomfortable. It can even feel irresponsible. Selling, on the other hand, feels like action. It feels like you're taking control of the situation. But here's the catch: selling doesn't just solve a problem, it creates a new one. Because once you're out of the market, you now have to decide when to get back in. And that decision is often even harder. Most investors don't jump back in right away. They wait for things to feel safer. They wait for clarity, for confirmation that the market has stabilized. But by the time that confirmation shows up, prices have often already moved higher. So what happens? They sell low, wait too long, and then buy back in at a higher price. And that cycle repeats. Now let's bring in the role of market narratives, because this is something that really amplifies panic. Every bear market comes with a story. It might be inflation. It might be rising interest rates. It might be a financial crisis or geopolitical tension. And these stories matter. They provide context, but they also create a sense that what's happening is unique, maybe even unprecedented. You start hearing phrases like, this time is different. But if you look at history, while the causes of downturns change, the overall pattern does not. Markets fall. They adjust. They recover. Companies adapt. Economies shift. New opportunities emerge. The narrative changes, but the cycle remains. Understanding that can help you step back and avoid overreacting to the story of the moment. Now here's one of the most frustrating parts of investing. The worst decisions often feel the most logical at the time. When markets have already dropped significantly, selling feels safer. Risk feels higher, not lower. But from a long-term perspective, lower prices often mean better opportunities. Assets are cheaper. Future return potential is higher. But emotionally, it doesn't feel that way. And this disconnect is exactly why so many investors end up buying when confidence is high and selling when fear is dominant. That pattern is at the core of investor behavior in bear markets, and it's one of the biggest reasons why individual investors often underperform the market itself. Let's talk about the hidden cost of panic selling, because it's not just about the losses you lock in. It's about what you miss next. Market recoveries are rarely slow and predictable. They can be sharp, fast, and completely unexpected. Some of the best performing days in the market happen very close to the worst ones. So if you've stepped out of the market during a downturn, there's a real risk that you miss those key recovery days. And missing just a handful of those days can significantly reduce your long-term returns. This isn't about picking the wrong stocks. It's about being out of the market at the wrong time. And that's a much harder problem to fix. So what separates investors who navigate this well from those who don't? It's not that experienced investors don't feel fear. They do. The difference is that they expect it. They understand that volatility is part of the process, not an exception. They focus on long-term goals instead of short-term noise. They have a plan, and more importantly, they stick to it. And they often see downturns not just as risk, but as potential opportunity. Now, having the right tools can make a big difference here, because a lot of panic comes from uncertainty. Not knowing what to do, not having a clear system, feeling like you're reacting instead of following a plan. That's where using a structured, intuitive platform can really help you stay grounded. If you're looking for a world-class, cutting-edge, user-friendly trading platform app, I'd recommend taking a look here at crystalballmarkets.com/platform. It's designed to give you clarity and help you stay aligned with your strategy, especially when markets get volatile. And alongside tools, education plays a huge role. The more you understand how markets behave, the less likely you are to react emotionally. You start to recognize patterns. You understand cycles. You see volatility as something normal, not something to fear. If you want to build that understanding, I'd strongly suggest checking out this beginner-friendly trading, investing, macro, and financial markets podcast at rss.com/podcast/crystalballmarkets. It's a great way to deepen your knowledge and develop a more disciplined approach over time. Now, let's bring this back to practical steps, because awareness is important, but action matters too. If you want to avoid panic during a bear market, preparation is key. Have a clear plan before volatility hits. Know your goals, your time horizon, and your strategy. Diversify your portfolio so that no single decline has an outsized impact. Invest regularly if you can. That removes the pressure of trying to time the market perfectly. Limit how much noise you consume. Constant headlines can distort your perspective. And when markets fall, pause. Review your strategy. Most of the time, the best decision is no decision at all. Finally, I want to leave you with a shift in perspective. Instead of seeing bear markets purely as something negative, try to see them as part of the process. They reset valuations. They create opportunities. They test discipline. Yes, they are uncomfortable. That's unavoidable. But they are also where long-term investors often position themselves for future growth. So the next time markets start to fall and that feeling of panic creeps in, remember this. The challenge isn't predicting what the market will do next. The challenge is managing your own response to it. Because in investing, avoiding big mistakes is often far more important than making perfect decisions. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia, and I'll see you next time.